Welcome back to another episode of the Tip Share. This week, we're going to cover how do small business restaurants make a profit. So let's jump right in and let's start with what is restaurant profit margin. This is one of the most critical metrics to understand and track as a restaurant operator, your restaurant profit margin. Simply put, to remain in business, you need to understand your margin and everything that goes into them. This seemingly simple metric contains a fair bit of complexity underneath the hood. The formula to calculate restaurant profit margin is as follows. You take your revenue minus your expenses, divide that by sales, and multiply that by 100. This is going to give you your profit as a percentage of sales. So the formula here represents your revenue minus your expenses in a given period divided by your sales for that exact same period. To understand your profit as a percentage of sales, we have to multiply that number by 100. Great. So now let's break that down even further. It's important to know that there are two classifications of profit margin, gross profit and net profit. The difference comes from how you calculate your expenses. Gross profit deducts only your costs of goods sold, while net profit subtracts every type of expense that you have. Two very different things and an important distinction to know when you're looking at your financials. So let's talk about net profit margin even further. Let's break down the components of the formula for the net profit margin. Revenue. Your revenue is the total of your restaurant's income streams, such as the dining room, bar, catering, merchandise and retail, and banquets, venue rentals, etc. All of the different revenue streams. Next is your expenses. This is all the money going out the door, like rent, payroll, food and beverage costs, and equipment depreciation or leasing costs. Lastly, we're going to talk about sales. So your sales are pretty self-explanatory. The sum value of everything your guests have purchased. Great. So now you might be wondering, what is the average restaurant profit across the industry? Average restaurant profits across the industry vary. The range typically falls between 2 and 6%. However, there's also a variance within the industry itself. Full-service restaurants usually fall on the lower end of the spectrum, while quick-service restaurants and food trucks will cluster a bit higher. Wherever you sit in the profit margin range, you'll need to run a tight ship to turn a regular profit. This comes with proactively managing your overhead, labor, and costs of goods. The first step to reliable profits is having accurate sales and cost figures, which are made markedly more accessible by using a modern restaurant accounting software. When discussing restaurant profit margin, it's critical to also look at break-evens. Understanding break-even points is one of the most reliable guideposts a restaurant operator can have in guiding more substantial margins. Break-evens indicate how much in sales you need to meet your fixed and variable costs, and they help create more precise budgets and accurate sales forecasts, ultimately improving that bottom line. Break-evens fall into two separate categories, the first of which being cash flow break-even. This factors in your restaurant profitability, plus your debt servicing, government assistance, and anything else that does not show up on your profit and loss, but needs to be factored into your cash management strategy. The second of which is going to be an operational break-even. This is going to help determine at what point your sales meet your complete operational expenses. How much do you need to make in sales to live to fight another day? This type of break-even will assist you in determining budgets, goals, and operational directives. So now you might be asking, how to make our restaurants more profitable? There are two ways that operators can improve their bottom line. You increase revenue relative to your expenses, or you decrease costs relative to sales. So a great way to do this is bar programs and table turnover. Focusing on each of your primary revenue streams, typical dining room, the bar, catering, merchandise and retail, banquets and venue rentals. Dining room and bar sales are usually the most significant contributors, so you got to pay special attention to them. Firstly, looking at your bar. Remember that margins on alcohol can reach up to 60%, making them by far the most profitable sales category. Lean into this advantage with appealing selections of wine, beer, and cocktails. Your dining room profitability can also be increased by making more money per customer or by increasing the number of customers served. For the latter goal, it's key to establish a high table turnover rate. This means increasing the number of customers served in a given period by reducing the average time spent at tables. Fast casual restaurants have customers dine and dash at an advantageous pace. The more people you can serve over a given period of time, the higher your profit. A higher turnover rate also compensates for limited real estate, allowing you to effectively fit more people into your space. You can also increase revenue by working with your chef to engineer a menu with more profitable dishes. Additionally, you can train your team to merchandise your menu items. Upselling or merchandising your menu is essentially training your team to understand menu items in relation to their contribution margins. Just like engineering your menu is creating a menu that caters directly to contributing margins. Next, driving repeat business is another time-tested strategy to increase your sales. Your best customers are the ones you already have. They've already made decisions to patronize your business, so your customer acquisition cost on repeat visits is near zero. Take advantage of that by cultivating a regular clientele. Positive word of mouth can be one of the most potent advertising tools you have. And as a bonus, it's free. An additional way to create repeat business, especially if you're a quick service restaurant, may be customized reward programs that incentivize these repeat purchases. Lastly, in the age of smartphones, having an online presence has gone from nice to have to need to have. Prospective customers will look for information about your restaurant online. They'll want to see things like your menu, the address of the business itself, your hours of operation are a bare minimum. Have an up-to-date website and a Google My Business listing. A well-managed website can become a business asset with multiple advantages from digital marketing to online orders. You need to know your metrics. Understanding your KPIs, your key performance indicators, is critical to cost savings for a restaurant operator. Without these clear and timely financial indicators, you're flying blind and will be unable to take proactive steps to control these costs. Receiving real-time updates on business-critical metrics will help guide your areas of opportunity to see where you can decrease costs. RASI's business intelligence and data analytics empowers our operators to take swift action on financial metrics, drill down into sales trends, and use machine learning to make accurate forecasts. To decrease costs, you'll need to get a handle on your principal cost drivers, your prime costs, which are composed of labor and cost of goods. Prime costs can fluctuate greatly depending on what's happening around the globe. Commodity prices, staffing challenges, and consumer behavior can all affect your prime costs. Therefore, the more frequently you review your prime costs, the better. We recommend a weekly manager meeting to review your profit and loss for this reason. If you consistently address your data, you'll be better equipped to make educated business decisions based on opportunities presented in your analysis. Here are 3 strategies to help you control your prime costs. Review and forecast your labor to enable efficient staffing levels, then create your schedule accordingly. Additionally, another frequently overlooked cost-saving method comes from payroll compliance. Substantial fees are levied on restaurants that don't comply with the law on meal and rest breaks, overtime, and paid time off. These fees are easily avoided by conscientious management of your payroll. The next is to take control of your inventory to reduce waste, theft, and spoilage, and to optimize your menu to par dishes that don't sell and create dishes with high perceived value and that built-in profit margin. The last is going to be leverage relationships with your vendors to ensure you're getting the best deals with constantly fluctuating prices or finding cost-effective, subworthy items. All of these strategies are great, but go right out the door if you're not reviewing your financial statements regularly. Timely and accurate financial statements give operators the leverage needed to make necessary changes to their business. When you can view how departments are performing relative to budget, how your sales are trending, and have the knowledge and understanding to forecast your primary cost drivers accurately, you're empowered to drive positive, consistent financial results. Every operator must be intimately familiar with their profit and loss statement, their balance sheet, and statement of cash flow. Each of these measures is distinct, and each contributes to a unique perspective on the overall health of your restaurant financially. Thank you all so very much for tuning in to this week of the Tip Share. We'll see you next week.